Welcome to the Plan Solutions Incorporated podcast, where we give facts and insight on the latest happenings in the world of economics, financial markets, and personal finance. Plan Solutions provides advice on a variety of financial topics, including investment management, tax preparation and planning, and retirement planning. Chase has 25 years of experience in the financial industry, holds a certified financial planner and chartered financial analyst designations, and has earned a master's degree in taxation and a doctorate in business administration. Chase has a passion for helping clients down the path toward their financial goals. And I'm Jason LaChance, and on this episode, we're going to discuss stock valuations and growth rates, electric vehicle tax credit risk, review memberships to manage expenses, and a look at the Plan Solutions Incorporated office bulletin board. Mr. Armour, how are we in this new year?
Oh, doing all right. Got my, first cold of the season, which of course, it's going to happen as soon as the kids go back to school. They're going to bring all kinds of germs home, but yeah, good. I'm on the mend, although my voice probably sounds a little gravelly.
That's all right. We both sound a little Rocky Balboa, It's okay.
Yeah.
All right. Well, let's jump right into stock valuations and growth. The S&P is starting 2025 at high valuations following the strong returns in 2024. But sometimes people are a little bit skeptical when it comes to historically how expensive some of the prices can be in comparison to the earnings that companies actually generate. So what do we kind of want to help people understand about valuations?
Yeah. I mean, being here in the beginning of 2025, right? All the podcasts and investment company newsletters and everything, right? They're talking about their 2025 outlook. And one of the things, that pretty much all of them touch on is, the S&P 500 price to earnings ratio is 27.9. So let's call it 28, which is a high level, right? Which arguably would say that stocks are expensive. Basically what that means is that investors are paying $27.90 for every dollar of company earnings. Whereas if you look at the very long-term average, that's more around $17 for every dollar of earnings. So if the market were to correct to its historical average, the prices would have to come down 39% to get to that 17% price to earnings ratio. That does look worrisome, and it is a factor that we all should take into account. But there's also other factors that you need to, see to get context, right? And one of them is the pace of earnings growth. Historically, investors have been willing to pay much higher prices for companies with really high earnings growth rates, because the idea is if the earnings continue to grow at that high rate, it won't take long to, bring it in line with where prices are. And then after that, maybe, continue to see prices go up as those earnings continue to grow. So we took a look here. We looked at a little bit different analysis or factor, which is the price to earnings divided by the earnings growth rate, or often called the PEG ratio. And if we look at it that way, the S&P 500 current earnings ratio divided by its historical growth rate, which was 21.4% in earnings, that gives you a PEG ratio of just 1.3. And typically, you start to get nervous when you get a PEG ratio of 2 or higher. Kind of between 1% and 2% is normal. So given at least historically the earnings growth that we've seen coming into 2025, if that pace were to continue, it would say that stocks, really don't look that overpriced.
Now, is this a situation where sometimes people maybe don't think it out as far as a long-term investment? Because tell me if I'm wrong, oftentimes these companies too, they tend to have a greater sense of stability.
Well, that really depends. Depends. You can have high earnings growth rates from a variety of different factors, right? Sometimes these are, companies like right now that are in AI, where they're finding new markets and finding new sources of growth. Previously we saw a lot of it with the cloud web hosting, right? With
Right.
Amazon and Google and Microsoft all competing for that business, and as more and more programs are being migrated to the cloud, you saw really big earnings growth rate there. We've seen in other kind of more unusual type industries that maybe didn't get enough attention. But, great example would be coming out of the pandemic. We saw a big run up in housing prices, and we saw the home builders really show really strong earnings growth because they really went from kind of operating at a much lower level to kicking it into high gear to try and meet the demand for new homes. And those are companies where you could say, yeah, these are stable companies that, now are benefiting from this trend. But then also, a lot of times where you'll see that rapid growth is smaller companies or new technologies that are maybe not necessarily proven. It's just they're coming off of a very low base, right? If your earnings are very low, it's not as difficult to double them in a year. But if you're a well-established, stable company and you have, billions in earnings, it's not so easy to go out and double a number that large.
Yeah. Well, what about some of the other markets, for instance, foreign markets?
Yeah, and that's been a common theme that we're seeing other markets offering somewhat better valuation. So if we look at the foreign markets, the price to earnings ratio there is just 16.3. So really in line with the historical average. And we're seeing a PEG ratio of just zero point 0.8 because the earnings growth has actually exceeded that PE ratio. So in that case, you would argue, very underpriced. And even with slower expected future growth rates, that still puts that PEG ratio of around 1.5% based on the expectation that earnings growth will slow. So, still, yeah, looks, kind of in the middle of what you would expect given what we're seeing in terms of strong earnings.
Yeah. I do want to ask about small and mid-sized U.S. stocks, but you had mentioned that the, concerns when a PEG ratio is above 2 or below 1. And why is that? What does that indicate?
Well, it's just based on historical relationships, right? That if the price to earnings ratio is high and the earnings growth rate is low, so to have a PEG ratio of 2, it means the earnings growth rate is half of what the price to earnings ratio is. It means people are paying a very high price and we're not seeing the growth there. So that obviously, starts to become a concern that maybe this has moved from, the realm of investors coming in thinking long term about, being able to capture this future growth and more into the speculative area. Which often happens in market cycles, right? We go through, early periods where stocks appear relatively inexpensive compared to their earnings. So you may have a PEG ratio below 1, and you're saying, wow, I'm getting all this future earnings at a really inexpensive price. Then as stocks recover and are doing well in the middle of the cycle, that PEG ratio will likely move up as the earnings growth rate maybe moderates a little bit, but prices continue to go higher. Well, if that stock becomes very popular, right, maybe because of its good past performance and people start thinking, oh, I got to own some of that. You get the more short-term speculative investors trying to make a quick dollar or, maybe just not doing the research, but just going off of the past news cycle and the hype of that company. They may continue to pile in even as the earnings growth, maybe starts declining because maybe the company's somewhat cyclical or maybe the investments they've made in the past have kind of, run through their cycle and just aren't producing the same returns as they did early on. And that's when you can get a PEG ratio above 2, where people are paying a very high price, but the earnings growth rate is falling. And that's usually a sign that someone's starting to become overpriced.
Okay, thank you for the clarification on that. Let's talk small and mid-sized U.S. stocks.
Yeah, small and mid cap size. So a price to earnings ratio of 18.8. So a little above long-term average, but still, not too far out of line. And meanwhile, the historical growth rate of 15.9%, so that's just a PEG ratio of 1.2. The forward-looking growth rate expectations are 11.6%, so a little lower. But again, even based on today's price to earnings ratio, that would just be a PEG ratio of 1.6. So, it's somewhere kind of right in the middle of that desired range. So we're not necessarily seeing, the significant overprice at this point if you take into account the strong earnings trends. And of course, a lot of this would be dependent on your expectations for future earnings. If you think a recession is coming or you think, earnings growth rates will really decline, then maybe stock prices do look overpriced. But if you think that we'll continue to see economic growth and, strong job markets and strong consumer markets, et cetera, and companies will be the beneficiary of that in terms of continuing to report strong earnings growth, well, then it doesn't look overpriced at this point, which, by all indication, at least with where we sit right now, seems to be the case in terms of the broader economic outlook.
Yeah. Well, and as always, it's something we'll continue to monitor and give any updates if there is any more advancements and changes. Anything else you would like to add before we move to electric vehicle tax credit risks?
Well, I think what this does point out is, as we discussed, the PE ratio on large company U.S. stocks being quite high, and that's partly because their stock price performance has been better, right? So their prices have gone up more. But clearly there is quite a bit more value in foreign and small and mid cap. And so it really shows, the potential benefits for diversification. In this case, not just in terms of, managing risk, but possibly in terms of future returns, given those better valuations.
All right. Well, let's dive right into electric vehicle tax credit risks. We have talked about this in the past. You can go back in the archive of episodes because it can get quite complex. Are we seeing any rule changes since things were passed in August of 2022?
Yeah, so the Inflation Reduction Act kind of changed all the rules for electric vehicle tax credits. It used to be you could get a tax credit up to $7,500 on the purchase of an electric vehicle, up until the point where that manufacturer sold a specific number of vehicles. And then after that, credits were no longer allowed, from that maker. And so a lot of companies had basically hit that point and the credit had largely phased out. The new credit doesn't put any caps on the number of vehicles sold. Instead, to qualify, the vehicle has to meet, certain specifications. It has to have had a, certain portion assembled within the United States, and the critical minerals that the batteries require have to be sourced within the U.S. So very complicated. We've talked about this, as you said. There's a lot of tools to be able to look up the VIN number of a vehicle to find out if it will qualify. So that complexity combined with the fact that the new law has income limitations. So higher income taxpayers don't qualify for those credits. Mm-hmm. So all of these moving parts really has caused this credit to maybe, not be fully utilized. I think a lot of people are confused about it. And we've also just seen kind of a reduction in demand for electric vehicles. But, this might be a time that if people have just kind of been putting that off and thinking, oh, yeah, I know that exists. I'll delve into it at some point when I need a new car. It might be something that they want to look at closely because as we've talked about, this year is likely to be a big year for tax law changes, right? The 2017 Tax Act expires at the end of this year. There probably a lot of those provisions will probably be extended, but there probably will be a lot of tweaks around the margin. And this is one area where many Republicans have really targeted the electric vehicle tax credit in campaigning. And given that Republicans will have control of both houses of Congress and the White House, it seems like this is something where there is a possibility that it could be eliminated. Mm-hmm. It's been criticized for being too complicated, for not having the right incentives, for a number of things. And so you could see how it's something that just maybe doesn't get continued. And so I think anyone who is possibly in a position to take advantage of this credit and thinking, this is something they may want to do in the future, this might be the time to look more seriously. You don't want to wait until the last minute if the credit isn't extended or is repealed. And also, if there starts to be some news about this credit, not continuing past 2025, you can imagine how that can cause a lot of people to suddenly say, okay, I need to take advantage of it before it's gone. You could have a situation where there's just a shortage of electric vehicles on dealer lots, which could push up prices or, limit availability or create all kinds of challenges if suddenly there's a run on taking advantage of this credit before some period of expiration.
Yeah. Well, and like you pointed out, that there are ways to be able to go take a look at the VIN number, make sure that it is one of those vehicles that is approved. It is really quite complex. So it's good to keep this all in top of mind if you are looking to switch to an all electric vehicle. And some of the confusion that people have too oftentimes is, oh, well, a hybrid, and that is not part of this tax credit.
Yeah, it is pretty complicated, so you do need to do your homework. But obviously, $7,500 is pretty good compensation if it qualifies in terms of tax savings. And even for those that maybe don't have a high enough tax liability to get the full benefit, there are provisions where you could quote unquote sell that credit back to the dealer, and so therefore negotiate a lower price to still get that benefit.
Yeah. All right. Well, let's jump into review memberships to manage expenses. It's always good at this start of a new year to review your budget, have a game plan to reduce expenses. And one of those big things that people are really seeing is reoccurring subscriptions that they don't even use.
Yeah, years ago, this became the big thing in business, right? Instead of a transactional nature, tried to get everyone on a subscription model. So that way companies, have this reoccurring revenue, it's more consistent. And in many cases, people, just don't think about it and are unlikely to cancel. As opposed to, them actively having to do something to give you money. Now they actually have to actively do something to not give you money. So you can understand how that really caught on. And what we've seen is a lot of people, have utilized those subscriptions, and then they continue to add up, and in a lot of cases don't have a process to go back and review them and say, okay, am I really using this, right? Whether it's a, streaming service for at-home entertainment or gym memberships or even, magazines or other periodicals, right? Are you actually getting value out of this? And if not, this might be a good time to go through and review and cancel, or even, create a strategy. I know people that with all the different streaming services, right? I mean, remember the promise was if we cut the cable, we'd save all this money, and you just pay $9 a month and get this, but now you're paying $9 here and $30 there and $50 there, and I think it's evolved where there's really not much savings there anymore. But one of the values is, unlike the old traditional cable package, you could go in and you could say, okay, I've got, 3 different streaming services. They're all releasing new content at different times. Do you need all 3 of them at the same time? Maybe you just choose one of them and go through that catalog for the span of several months, and then 6 months later, cancel that one and subscribe to another one, and then there'll be 6 months worth of new content that you could go through, and just continue to do that. Now you might always be a little bit behind on some of the new things that are coming out, but it can really add up to significant savings when you're not paying for all of that broad content, but rather just really focusing on using it from one source and then moving on to the next.
Yeah, and I do see that oftentimes is that FOMO, that fear of missing out on the hot show or whatever it is that everyone is talking about, and that can be it, as well as some of the things that I noticed into the year was options to save quite a bit over the year in bundle packages and things of that nature too, where you can look to even consolidate there. I think I ended up doing something where I saved almost $350 a year. So some of those options, but the one big thing that definitely I know that a lot of people have purchased and maybe underutilized, that gym membership.
Yeah, I mean that's a big part of the model for gyms, right? I heard someone say if everyone who had a gym membership showed up on the same day, they would be over the fire code limit by like 1,000-fold. I mean, so often it's an aspirational thing that we sign up, we plan to go. Maybe start out good, just like a lot of New Year's resolutions, but then, don't necessarily follow through. Maybe keep having the intention to go back and use it. But, if it's just not happening or you haven't been using it for quite a while, I mean, that can be a great place to save money and possibly look for other alternatives, things that you can potentially do at home with a lot of the, different workout, technology or media that's available, or look at gym memberships through workplaces or things like that might be available that could create some savings.
Yeah, and you point out one thing too that people should explore their healthcare plan potentially because some of them do have gym memberships now as a part of it, so that's something to look into for sure. One of the last ones, magazine subscriptions. I know some people don't think about that as much anymore. We don't buy as much with print. But boy, I had one that I completely forgot about. I think this was in 2022 that was a digital resource. And boy, I did not utilize that at all. But for whatever reason, I kept overlooking that $2.99 a month.
Yep, which over a long time period adds up. Yeah, and it's easy. I mean, you have the ones that maybe come in the mail and you may be able to switch it to digital if you use it, right? And it could be more cost effective that way because obviously there's not the costs of printing and mailing for the publisher. But then yes, the digital ones can be really easy to forget. You have it bookmarked somewhere and then okay, did we even use it? I know, going back to like the entertainment streaming, years ago, there was one of them that had a very inexpensive deal over the holidays, right? Like 1 year. And my wife thought, oh, that seems like a great deal. And it's so inexpensive. And she got it. I don't think we ever actually even set up the full login or even looked at it, right? I mean, because we had other things that were, top of mind if we were watching something and just completely forgot we even ordered it. And, with a lot of those, it's like you sign up and then the next year, right, they're going to bill you. And then suddenly it's like, oh, yeah, I need to cancel that. And even though it seemed like very low cost, I literally got zero value out of it over the previous year.
Yeah. Yeah. And that brings up that good point of maybe something where you sign up and it's just you get a reduction for paying it annually right away. And it's on auto renew and you forget about that. I have had that happen as well.
Yeah, those can be harder to catch because they just hit you once per month. And if you're not paying close attention, yeah, it can be easy to skip right over it.
Yes, sir. All right. Well, let's jump on over to the Plan Solutions Incorporated office bulletin board. We have one item pinned up there.
Yeah, so just our annual reminder here, we're gearing up for tax season and companies are starting to send out W-2s and some of the other tax forms. We just want to remind everyone, as you're preparing, I mean, one, there's a lot of, forms that might kind of slip by, right? I know like my mortgage company, they send the 1099, it's right behind the monthly statement. And a lot of times that monthly statement, I just pull that off the top and file it and throw away all the, junk newsletter notices, things like that really aren't important or advertising for other services. And you don't want to do that and accidentally throw away that 1098 because it just can be a hassle to go back and try and find it again. Also a lot of companies, they're not able to send out tax forms until early February, or in some cases, with like more complex investments and things even much later. So, one, it's important to be patient and kind of have a list and check it off as you go. And two, really pay attention to mailings this time of year.
Yeah, really great point. And I've also noticed this too is I've actually already been getting emails from some companies that all of my tax forms will be posted online for download rather than receiving them in the mail.
That's a great point. Yeah, that's becoming more and more common. And of course, if you lose that email or delete it or, might not have that reminder to go back and, oh, yeah, I need that form. I know we send out a tax organizer that shows everything that was reported from the previous year. So it can be a great way to use as a reminder or sometimes just kind of make a checklist and think, okay, what are all the forms that I'm going to need this year? Because it does make it a lot easier to prepare a tax return when, you have at least the bulk of the information to work with. When you're trying to do it kind of, piecemeal, one form at a time, to be honest, it's just a higher probability for mistakes.
Yeah, absolutely. And of course, as always, if there's any questions, folks can reach out to you there at Plan Solutions.
Absolutely.
Anything else you want to add, Mr. Armour, while we wrap up this edition of the Plan Solutions Incorporated podcast?
Well, as we were talking about before we started recording, just, thoughts and prayers go out to everybody affected by the wildfires down in LA. I mean, it's just unbelievably devastating what the fire can do with those winds, and people that are losing so much. The heart goes out to them.
Yes, absolutely. And we thank you all for listening to the Plan Solutions Incorporated podcast, of course, on Apple Podcasts, Spotify, where you can leave us a rating and a review, or on YouTube by going to youtube.com/@plansolutions, and you can follow along actually to the personal financial review and hear the discussion we have on the topics. So please subscribe there, leave a thumb up on the video, a comment, or if you even have a question, that's a good place to leave a question, and we'll make sure it gets to the staff there and something that might show up in a future personal financial review as well as on the podcast. And if you have yet to subscribe to the written content we discuss here, send Katie an email and get subscribed today. That's KATIE@plansolutions.com.
The views and opinions expressed in this podcast should not be construed as an offer to buy or sell any securities. The information may not be current, and Plan Solutions has no obligation to provide an updates or changes. Plan Solutions does not make any representation or warranty as to the accuracy or completeness of the statements or any information contained in this podcast or any liability therefore, including in respect of direct, indirect, or consequential loss or damage, is expressly disclaimed. Plan Solutions is not providing any financial, economic, legal, accounting, or tax advice in this podcast. In addition, the receipt of this podcast by any listener is not to be taken as constituting the giving of investment advice by any Plan Solutions associate or individual to that listener, nor to constitute such person a client of Plan Solutions. Any reference to a specific company or security does not constitute a recommendation to buy, sell, hold, or directly invest in the company or its securities. Market indexes are unmanaged and cannot be invested in directly. All price references and market forecasts correspond to the date of this podcast.
Plan Solutions is a registered investment advisory firm.